Hey, what's going on, folks? Looks like I at least have one viewer on already, the Epic Hamster, as always. Yeah, buddy, today is a really big earnings day, and I think that we're all seeing now the reason behind Facebook's push towards the metaverse. You want to take a look at what's going on with Meta right now, or with Meta platforms, whatever they're calling themselves right now, is they're down 22%, and they basically have had the first quarter of declining active users for the first time ever, and a rare earnings miss. And guidance was dramatically reduced. They're looking at reduced revenue for the future. So I think really this isn't a reflection of the overall economy at all. It may not even really be a reflection of all the issues that they've had with the social media platform promoting different ideas out there. I think it's just the maturity of the platform. They're not as big as they could possibly grow, but they're about as big as they're going to grow, and now they need to find new avenues for revenue creation. And their push into the metaverse represents that to a degree. So I think that this is not an accident. The way that the announcement for Meta platforms was made, I think that they knew ahead of time, of course, that monthly active users were starting to, or at least the acceleration was declining. But this is the first time we've ever seen monthly active users actually decline for Meta platforms. So that's a big day. The other big thing in earnings this year, or this time around, was Google, of course, with their giant earnings beat and announcing that 20-1 split. Which, guys, I got to think that this has to be a move to get them on one of the major indices, right? Possibly like the Dow Jones or something like that, because they won't do it because it's a price weighted. I think that was a price weighted index. They wouldn't do it with them at close to $3,000 a share, but they're happy to do that with them at close to $150 a share, something like that. So I do think that is all exciting news. I think some of the big news, though, if you look at Investors Business Daily here, and let's take a look at that here for just a second. If we look at Investors Business Daily, this is one of the bigger news stories that if you watch my channel, we tend not to talk about some of the more boring stocks out there. But this is one that's really related to a lot of things that are going on in the economy right now. And I'm talking about UPS, of course. UPS stock breaks out after earnings easily beat and hikes their dividend by 49%. That is a really, really big deal, folks. So Wall Street expected UPS earnings to rise 17% to $3.10 a share, with revenue up 9% or to $27 billion. But earnings actually rose 35% to $3.59 a share. Revenues continue or climbed 11.5% to $27.77 billion. I think they were looking for a little bit of a growth slowdown here, and because we're sort of normalizing or finding a new normal after coronavirus. But it looks like that a lot of the buying and shipping patterns that were put into place during coronavirus lockdowns are going to be persistent. Excuse me, I'm about to sneeze here. Excuse me. All right. So UPS stock shot up 14% to 230.69, and shares have been flat for a while. And I really think that it's the really large issue, or the really large raise in the dividend, that's going to cause this stock to climb and climb and climb. UPS, if it's not in your portfolio, it probably is. If you hold any sort of large cap mutual fund or ETF, you own some UPS. I know personally, when I first got into the industry years ago, I want to say it was maybe 2005 when I first got licensed as a broker. Before that, I was a programmer in the financial industry. When I got licensed as a broker, I think it was right around then that UPS went public, and I met a few like drivers who had become millionaires, who had $1 to $2 million in UPS stock, and they retired and were actually living mostly off of the dividends at that point, because the dividend was pretty high. Now, this is a company that actually grows dividends fairly regularly as well. Like I said before, not as exciting as a PayPal or as a Google or a Tesla or something like that, but a money maker over time, and a compound money maker over time. So UPS reports that the world shipping network remains clogged, a product of COVID restrictions and difficulties attracting labor that can be low paying and tiring, with available containers not always where they need to be and workers demanding better compensation. The price to secure shipping space and to get product shipped rose. So that is certainly a concern for them. And I think that's a concern for a lot of people. So I am happy to take any questions that you guys might have out there. And I'm going to look at some of the news that's out there in terms of earnings. And I'm just going to be happily typing away on my computer and waiting for you guys to come up with questions. And yeah, so let's talk about PayPal's earnings guidance here. And I do think that for some of these fintech companies, we are, and all fintech companies have really suffered in the last, 3 or 4 months since about November. PayPal has kind of suffered a little bit of a double whammy here, where eBay's kind of announced that they're moving away from PayPal as their primary payment platform, and they're going to be doing other things. The announcement, of course, that for both Square and for PayPal, that the iPhone is now going to be able to process payments all on its own. That could potentially that will affect their bottom line going on. But all of these companies are diversifying what they're doing in terms of how they grow their revenues. But shares in PayPal fell off more than 24% on Wednesday, closed at 132.57. And basically, they wiped out about $50 billion in revenues. Anthony Walker, I think in the long run, that PayPal is bought at 131 in the long run is probably not going to be a big deal. And I think that you'll recognize in the future that that's going to be a pretty good price that you bought that at. But let's be prepared for volatility right now. I don't think that volatility in technology is over. I know that we've had a bit of a breather in the last couple of days, but I don't see us really out of the woods yet. I don't really see us being out of the woods until after that first rise in interest rates. That first rise in interest rates is going to be a shock no matter what. And the Fed has definitely signaled that that's happening. I know that I watched a video or a YouTube video from someone basically claiming that that the Fed is kicking the can down the road in terms of a rise in interest rates, based on a few things that a couple of folks said. And it's never a couple of folks associated with Federal Reserve. That's never an accident. The interpretation that I got that was very different, though. I got an interpretation from what they were saying that they were definitely going to raise interest rates on March 16th, probably a quarter point. I know there's some threats of a half a point out there. I think that would be a big shock to the system. But I think that no matter what happens, because the market has not seen an attempt to raise interest rates since 2018. In 2018, Jerome Powell came out very hawkish on inflation, on interest rates, on cooling down the economy, and maybe came out a little bit too hard, and we saw a huge market decline in that case. And then he backed off of that statement, and then we saw this boom in 2019, right? So that was very much driven by the Fed. And what happens next in the market, to a degree, is going to be driven by the Fed too. But let's remember, there are a few things that the Fed will not be able to control. They cannot control the rise in wages. The rise in wages is not, and inflation is not a U.S. phenomenon. It is a worldwide phenomenon. I know that a lot of people want to say that inflation right now is all due to politics or all due to Fed decisions. It's not, folks. Europe right now is seeing some of the highest. In fact, let me bring up that article right now here. Let's talk about that. Let me see here. So what we see here is that Eurozone inflation unexpectedly hits record and boosting interest rate bets, meaning that most people think that there's going to be a rise in interest rates by the European Central Bank. Now, the European Central Bank's mission is quite a bit different than the mission of the Federal Reserve here in the U.S. The European Central Bank has a central mission, and only one, and that is to control inflation. Now, if you boil down the U.S. Federal Reserve's mission, it's really full employment and to control inflation, right? And then the primary tool they use for that is controlling the federal funds rate. But that is not necessarily the case for the European. Because they look at inflation as the primary cause of the rise of fascism in Europe, and they are desperate to prevent anything like that from repeating, right? So they're also quite a bit more hawkish when it comes to clamping down on interest rates and making borrowing more expensive, which to a degree is not necessarily very good for us in terms of our sovereign debt. It's going to make European debt a lot more attractive to fixed income investors. And so no, I think that this is this is concerning for fixed income investors, probably not so much for the general public, but it is an indication, of course, that that inflation is actually worldwide. It's not just limited here to the U.S. A lot of it here in the U.S., though, I think has more to do with wage inflation, where wages are rising pretty fast for people in the lower income strata, which is not necessarily a bad thing, but that's being compounded on top of supply chain issues and availability, availability of things like shipping containers, which is also causing a rise in price. So inflation is complex. It's not easy. Anyone thinks that they have one simple explanation for it is incorrect. Even academics who study inflation all the time don't agree on all of the causes of inflation here. But we're looking at, they use different things to measure. Of course, their energy prices are way up, just like everyone else's. Our non-energy industrial goods up 2.3%, services up 2.4%, food, alcohol, and tobacco up 3.6%. And all items HICP, which is basically everything in their Eurozone there, is up 5.1%. So fairly similar to what we're going through. Not anything like what Turkey is going through there, where they have basically runaway inflation at this point. That is mostly due to a government policy there, where the Erdogan in Turkey has simply decided that he doesn't believe that higher interest rates will stop inflation. And he doesn't have a reason not to believe that. So that's kind of interesting. So yeah, that's one of the things I wanted to talk about today. Just inflation being a worldwide phenomenon. It's not limited to here, and it looks like it's most likely due to supply chain shocks. Just the demand is there for things. Lots of people want to buy things, but the supply chain is so snarled that they just simply can't be delivered in time, and they're going to the highest bidder. Once we see a normalization of the supply chain, of course, good old-fashioned capitalism has a solution for everything, and competition will probably drive prices back down again once supply is available. One of the things we are seeing, though, and Kathy Wood mentioned this in her, it wasn't the Big Ideas, maybe it was the Big Ideas podcast she did a few days ago, talking about how in the U.S., at least, post-holiday, we've seen a buildup of inventories for retailers, which is something they weren't expecting. So, Patrick Dillon says, are there any new companies that you are looking to invest in or recently invested in? So generally, if I have invested in something in the last 5 days, I don't say anything about it until after that's over. If I'm planning to invest in something in the next 5 days, I don't say anything about that. In my Patreon, we definitely discuss what we're looking at a little bit more. I will say one thing, Patrick, though. I'm actually looking for newer ideas. So I'm shifting my perspective a little bit on the next 5 years. What I'm really seeing here is a convergence of things around AI and advanced computing, right? So I'm looking at basically at genomics, at cloud infrastructure. I'm looking at autonomous technologies. I'm looking at numerous things, metaverse. I'm looking at augmented reality. I think augmented reality is going to be a far bigger deal than people think it is. I think that we're going to be driving an augmented reality pretty soon, where our screen is actually going to be contain a lot of information that helps us, do things like the actual windscreen of our car is going to have data and information projected on it in order to help us drive and things like that. So augmented technology or augmented reality is going to be a larger part of our life here pretty soon. So I'm shifting my perspective here in terms of how I want to invest in the AI space. Now, typically, I've owned a lot of individual companies out there that a lot of other folks have, but I am actually looking out there right now. And this is one of the discussions I'm having in a private Zoom meeting with my Patreon group next Monday. What are some of the companies that we can invest in that are really centered in that AI space? And I want to get the broadest amount of ideas out there because I think we don't really know what's coming down the road. I just know that there's going to be a transformational shift and really what Kathy Wood calls a creative destruction of wealth, meaning that creativity in one area is going to shift wealth. And folks are basically going to destroy some of the old ways that folks were doing business, some of the older companies. And look, I think that there's even room for some of the largest technology companies out there to be disrupted. So so we are definitely looking for some of those ideas. All right, so Anthony Walker says, a friend of mine thinks the economy is doing great, and I don't agree. What do you think? So I know I actually do think the economy is doing just fine. I think that a lot of what's going on is overblown. The concern around, I mean, there's a lot of concern, of course, over money supply. I think a lot of people really don't quite understand what's going on there, but the economy is in better shape than media would have you believe. Remember, everyone has served the media that they want to see. And the YouTube algorithm and the Google algorithms know exactly what you want to see, and that's what's served to you because they want to keep you reading and keep you watching, right? So to understand how well the economy is doing, you really have to look at all of the leading or trailing indicators that are put out there by various companies that do this research. And actually, things look fairly well. Do they look like they're going gangbusters? Like when we saw that the economy grew last quarter by 6.8%. That was a bit surprising to me. I didn't realize it was that good. And I think on this, when you look deeper down, it isn't really all that great, right? But I do think that if we have a normal year of 2 to 3% GDP growth, that's actually considered really good growth. That's not stagnant growth at all. 2% growth is historically fairly decent. It's not great, but it's decent. And in a lot of ways, when you look at the staggering pace of the economy over the last couple of years, that's about what you can expect. We have not had a serious stock market decline since 2008, at least, not one that was driven by an external factor like a war or, a pandemic or something like that. And that still looks like it's the case today. We're not seeing a slowdown in earnings, not a real one at this point, and we're not going to see a contraction So basically, a recession is defined by 3 consecutive quarters of economic decline, and we have not seen that yet. I don't know if we're going to see that this year. I think it looks unlikely. Based on how quickly the economy expanded last quarter, if we saw no expansion this quarter or a slight decline, it wouldn't really surprise me. But yeah. Tom Lou says, what is your view on Sava? I don't have an opinion on them. That's something I'll have to look at. So just want to remind you guys, these super chat features are on if you feel so inclined. I really do appreciate when that happens. So Midos 27 says, hey Jason, what do you think about Tesla's Q4 earnings? And at what market cap would you consider to buy a strong buy? Now we're seeing some decline in the market. So I kind of laugh at market cap quite a bit, right? So and for a couple of good reasons. So the stock prices are not always logical, and they're not always, and for many things, they're not always logical, and they're based on what you think the future of the company is going to be like. Like there really isn't a reason why Tesla's stock or total market cap should be larger than GM's. GM makes 7 million vehicles a year, and Tesla just passed 1 million, right? And there's no guarantee that they can actually execute on everything they say they can execute. And if you look at the history of Tesla, they do deliver on their promises. They just never do it on time. But yeah, I do think that market cap is not the best way to judge what a company is worth. And if you look at Tesla and just based on the market cap, then there's been no price pretty much ever that you could have said this is justifiably a great investment. You're really betting on the innovative potential of the company, and that's something that's very, very hard to quantify. At no point has Tesla, and I'm a long time Tesla investor, but at no point has Tesla been a wise decision at the moment you made the decision. It's only been a wise decision years down the road. So one of the things that frequently happens, and I've been in Tesla for over 10 years now, for right at about 10 years, actually. One of the things that frequently happens is really long flat periods in Tesla where so it would be really frustrating if one of those flat periods for me was like a down period for you, meaning I got in when the stock was really low, made some good money, but then there's sometimes for like a year, it didn't grow at all, 1.5 years where I was kind of underwater from a previous point. Now, because my acquisition cost was so low, I didn't really mind so much. But I'm telling people about Tesla. They bought it at $130 a share. A years later, it's still worth $130 a share. And a year later, and they're like, Jason, what's going on? And they had this disappointing experience where at the same time I was completely satisfied, because I'm looking 5-10 years down the road at the plans that Tesla had, which they laid out in their master plan 1. They laid out in their secret master plan 2. And have they updated the secret master plan 3? Is there a part 3 out there? I don't know. So I'd have to take a look at that. But honestly, I think that purchasing Tesla right now, even at these prices, is fairly attractive. Now, I will tell you guys that I have sold some puts out there because I'd like to take advantage of some of the volatility that's going on right now. So I sold a marginal secure put at 790 out, I think, about 6 weeks, meaning if the price dips below or closes below 790 at any time in the next 6 weeks, then I'm on the hook for 100 shares. I'm happy to own that stock at 790. I bought some at 990, and now I'm underwater. But I'm happy to own it at 990 because I know that in the future this company will be worth more and more and more. That, and remember, folks, you can always sell, even if you don't really want to sell the stock. With Tesla, you can sell calls so far out of the money and generate $100 a week or $200 a week. It's so far out of the money that they're never going to get executed, or it's extremely unlikely that they're going to get called away. So, yeah. Chris Palmer says, what do you think about uranium investments? Chris, I think you may have been fed the same video that I was fed by the YouTube algorithm, which was the case for uranium investments. I actually think that uranium investments in any case are probably going to be a good idea. Uranium is a limited resource. We're not making any more of that. Actually, technically, you can make more of that, but we're not. I mean, the planet Earth is not making any more of that. At least our star is not making any more of that. It has a use beyond just its fissile material. It's something extremely dense, and it's actually used. Depleted uranium is actually used in ammunition worldwide. And so it does command a price. It used to be a waste material, and now it actually commands a price. And there may be other uses for uranium besides fissile material and essentially really dense bullets that I'm not aware of. But I do think that it is I think that nuclear has to get more important. Like nuclear, if we're switching to the electrification of transportation, I'm all for renewables. I don't think that renewables are going to solve all of our problems. And I don't necessarily think that nuclear power is the big evil that many other people do. So I think that there is a future for uranium investments. So Tom Liu says the Alzheimer's disease solutions like SAVA and AVXL. Yeah, I don't know anything about that. I did want to talk about this real fast. And I'm just going to take a minute I wanted to talk about a little bit about Moderna. And let's talk about this right here. This is extremely important, but let's put this in context here, okay? WebMD, and I don't want people to go crazy over this, all right? This is really important. Moderna, I think, is possibly going to be one of the more important companies in the world in the next decade or so, but there might be other players that come up in this mRNA space. The COVID-19 pandemic really proved to the world. I mean, it was researchers have known for a while that mRNA research at some point was going to lead to serious medical breakthroughs, but I don't think people realize how fast you can. I don't think people realize how quickly you can come up with solutions to different things here. So, but this is a huge deal in terms of Moderna launching clinical trials for an HIV vaccine. But let's talk about what we're going to know from this HIV vaccine based on these phase 1 trials. And I'm going to tell you the answer is we're not going to know much, and we're not going to know much for a very long time. And it's because of how this trial is structured. So human trials have started for an experimental HIV vaccine that uses the same kind of mRNA technology found in Moderna's successful COVID-19 vaccine. So remember, though, these are two very, very different viruses. the virus actually targets, the immune system cells itself with HIV. So basically using mRNA to create a protein that can teach the immune system to fight off AIDS is a very different proposition than doing it for COVID-19. So the phase 1 trials are going to be run at the Hope Clinic of the Emory Vaccine Center in Atlanta, the Fred Hutchinson Center in Seattle, and the University of Texas Science Center in San Antonio. The vaccine is designed to prompt white blood cells to turn into antibodies that can neutralize HIV. And a booster shot is going to work with this vaccine is also going to be studied, right? So we've been trying to come up with a vaccine for the last 40 years for this particular disease, and it hasn't happened. And we're not going to know that much about this particular vaccine after this phase 1 trial for one very good reason. Now, there's only 50 people in this initial phase 1 trial. And the reason we're not going to know too much about how effective this is because of ethics. There really just isn't an ethical way to take these people, these 50 people in this group, and then expose them to AIDS, right? And I'm sure there's ways you can do that in the laboratory. You can see if there's an immune response, but it's not the same thing as actually having someone who is going to be irresponsible or unlucky enough to expose themselves to the virus under natural circumstances and be able to. We're not going to know as much as we want to from the single trial. Phase 2, of course, you're going to have a much more structured way of creating the group of people that you have. You're going to have a much wider sample, a much bigger sample size. And of course, that phase 2, you'd start looking at like blind testing and that sort of thing too. Once again, though, not a way to ethically expose these people to AIDS. You have to do that in a laboratory situation. So yeah, it's going to be a long time before this actually means that Moderna is making billions of dollars with an AIDS vaccine. It's going to take a long time before that happens. And this therapeutics are gaining steam as well. And AIDS is no longer the death sentence that it once was, but this is really exciting. As an investor, it's still exciting, but it's not something that I think is really going to make you want to go out and, pump all your money into Moderna at this point. The approval for this is a decade or more away, I think. But other diseases that are coming out, you're going to see that there's going to be a super rapid turnaround now when it comes to vaccines for other diseases that come out. I don't know if you have read into the story of how Moderna came up, not with Moderna, those two scientists in Germany, those two Turkish scientists in Germany, basically got the virus sequence from the World Health Organization, and within a couple of days, they had designed, at least on a computer, the vaccine that they needed, and they produced it in sort of under a week, from what I understand. It's amazing. So, Jason, did you already touch on Biden's cancer moonshot statements? No, I'm not actually familiar with what you're talking about, so I'll have to look that up here. Moonboy says here, how many what's going on? So, all right, Moonboy says, how many rate hikes are you expecting this year? What basis point do you think the rate hike to 1% is priced in? I do. I think a rate hike to 1% is I think a rate hike regime all the way up to 2% is pretty much already priced into the market. Meaning that I think that the target that the for now, at least, the target that the Fed wants to get to eventually is 2% is 2% federal funds rate. I think that, and I'm old enough to remember and have worked in periods where that rate was a lot higher. The best signal that says we're looking at going into a recession is when you see the rate curve, the interest rate curve, to be inverted, right? And some of you folks have never seen this. The last time it happened was in 2018. That was close to being, and that was definitely caused by the Federal Reserve, where when I say the yield curve is inverted, it means that short-term interest rates are actually higher than long-term interest rates in anticipation of a recession. That's usually one of the best signs that a recession is coming. And there's only been a few times that the yield curve is inverted, and we haven't had a recession. And the last time that happened was in 2018. And that was largely because Jerome Powell was a little bit too aggressive when it came to raising interest rates. But back then, he didn't have the same inflation concerns worldwide that he has now. And here's the thing. We may be stuck with inflation for a while until supply chain issues are ironed out, and that might take years to do, and until the labor market stabilizes. And the Fed can't really do anything about that. Like the U.S. labor market is not causing prices to rise in Europe. It's not causing prices to rise in China and Japan. Political, snafus in the United States aren't causing prices to rise in Russia, or food prices to rise in Iraq. And that's happening everywhere around the world at this point. And it has everything to do with supply chain. We had this massive, really unprecedented disruption, at least in the lifetime of most human beings here. But so here, so what is a decent max debt to income and debt to net worth ratio? So it really depends on what you're trying to do. Are you saying that because you want to go out and get a loan, and you're saying what is the max loan, or are you looking at the debt that you already have in your personal life? So 40% is sort of the general rule of thumb. When you go to you'll get a mortgage. They're looking at your debt to income ratio being that this mortgage that you get is no more than 40% of your debt to income ratio, total debt to income ratio. So that is one of the general rules of thumb. When it comes to being an investor, it really depends on how risk tolerant you are. I know people that are leveraged to the hilt, where their income, net worth, both mortgaged at 100%. I don't know how they find the credit. I know a couple of entrepreneurs that are like this, and they have successes, they have failures, they keep rolling success into failure and failure into success until they basically have enough interest where they can start borrowing from their own interests, right? There is no hard and fast rule on that. That's really dependent on your personal situation, and I think that's pretty important. So let's talk about some other big news out there. And I've touched a lot on politics today, which is something I almost never do, but unfortunately, politics is really affecting what's going on in the stock market these days. Let's talk about the big threat that the Biden administration made to Russia, which I don't think is being taken seriously and should be, at least not by Western media, and it should be taken seriously. This is a big friggin' deal, but it's something that we can't use very often. It's a tactic that we cannot employ very often because the potency of that tactic will go down. But basically, we have decided that if Russia invades the Ukraine, we're going to destroy the future of the economy of Russia. And I'm not talking about regular old sanctions that we had on a few Russian oligarchs, which they're able to circumvent. This is what I'm talking about. All right, here we go. U.S. threatens Russia with a chip blockade. Biden administration officials say that they're going to cut Russia off from the vital supply of semiconductors if it invades Russia with a broad sanction. And they say it's without precedent. It is sort of without precedent. President Trump did the same thing to a single company, Huawei. And that's the reason I say it becomes less effective the more you use this. But part of the Biden strategy is to inflict maximum economic pain on Russia and the administration. And they're going to use government restrictions on chips, not only chips made by U.S. companies, but chips made by foreign companies that rely on U.S. equipment, tools, software, and designs. Meaning, basically, we're going to give the world a choice. You can do business with Russia or you can do business with us. And because of the ubiquitous presence of U.S. technology in the chip-making supply chain, the blow to Russia could be staggering. Ed Mills, the Washington policy analyst for Raymond James, told Axios, semiconductors are the new weapon. Basically, this denies them access to economic development in any field that requires semiconductors. We're cutting them off from a future economy, and I think this is a big deal. In a way, I kind of find this a little bit scary, right? This is the step I wish that we didn't have to take, and I'm on the side of us not being so involved in international affairs, although I recognize we can't always avoid that. Anyway, big news. I think that threat makes war, a war between Russia and Ukraine, at least a large scale sort of traditional type war with Ukraine and Russia. I think it makes it increasingly unlikely. We would literally be cutting them off from the future. They would not be able to develop. They don't have the economic clout. Like Russia is not a supremely not the wealthy and powerful country that people think it is. Their economy is actually relatively small. Their main exports are oil and other natural resources. They don't really have a developed economy, right? Despite the fact they have enormous talent and specialization in a lot of things, they simply don't have the resources to create an entire semiconductor industry out of thin air. They may be able to cozy up to China to do that, but yeah, this is a big deal, and I think at least until Russia would have to come up with a whole new strategy to provide their economy with the semiconductor chips they need in order to actually execute on that. So, no, I think that's enormously makes me nervous, but it's actually kind of positive. It reduces the threat for conflict. Anyway, here to answer questions that you guys have. I'd love to hear from you. Just a reminder, the super chat features are on. Let me go back and see if I've missed any questions here. So I use third-party software called StreamYard to feed so I can put comments up on the screen. But I just figured out the other day that not all the comments that come across on YouTube are actually coming. Not every single one is coming across on StreamYard here. So if I miss your comment, it is not intentional. It is definitely an accident. I don't know. Somebody keeps leaving links on here too. So what do you think about Xpeng at this moment? They have shareholder equity of around 7.5 billion US dollars. So I actually just did a video a couple of weeks ago on Xpeng, and I talked about my prediction for them for the entire year. And I think that they were in the high 40s when I made that video, and I said that they were going to drop into the low 30s. And they were going to drop into the low 30s for a couple of reasons. And look, yesterday when I was reading articles, and I posted this on the Discord in my Patreon group, I read a bunch of articles on NIO, Xpeng, and Lee deliveries where they talked about how deliveries dropped from December. January deliveries dropped from December. And these authors all gave the reason why. And on Barron's, I made a mean comment on Barron's to the author of this one article, because I'm like, you guys didn't do any research on the Chinese market before you put your opinion out there as far as what caused the slowdown. So Chinese New Year was yesterday. Actually, is today the 2nd? Yeah, Chinese New Year was yesterday. Chinese New Year is a big freaking deal in China. And even though we know about Chinese New Year here in the US, we don't understand just how large a deal that Chinese New Year is. People who could go home to visit their family, who had the money to do so, and the Chinese working population is much more mobile in some ways than U.S. working population is, because they're drawing this huge population of people from rural areas into factories, into businesses, into enterprises in the big cities, and they still have these ancestral homelands that they can go back to. So travel for Chinese New Year started last week. So NIO, Xpeng, and Li Auto all lost about a week's worth of sales. So they lost basically a quarter of their time to do sales for the entire month. That's one of the biggest reasons for the decline in deliveries. It doesn't have as much to do with the cut in subsidies, and it has absolutely zero to do with a reduction in demand. Demand for electric vehicles in China right now is absolutely unlimited. I'll say it again. It is unlimited for this one very big reason. Yes, the subsidies are nice. You know what's really difficult to do in China? If you want to drive a gas guzzling car, it's extremely difficult to get a license for your car. You literally have to go to an auction and bid on it. And if you're in a large city where most of these NIOs and Xpengs and Leo and Li ones are sold, if you're in a large city, those can go for anywhere from $12,000 to $15,000, and you have to bid on them at auction. Meaning, you can go to auction with $15,000 and not walk away with a license plate. Yet, if you buy an electric vehicle, you get a nice government subsidy to do that. If it's under a certain price, yes, they did cut that subsidy, but your license plate is free. That is the biggest reason why there is unlimited demand for electric vehicles. The Wulong or Wunong or whatever, the Mini EV, I think it's called Wulong Mini EV. They sold like 40,000 units last month. BYD is killing it because they can, there's all kinds of things that are going on right now in the Chinese market that are not really well covered in Western media. But every single article that I read talked about the reduction in subsidies and a decrease in demand killed deliveries in January without anyone mentioning Chinese New Year. So, guys, next month, deliveries are going to absolutely suck for NIO and XPeng and Li Auto and even BYD, right? And that's because Chinese New Year may be what was on Monday, but ceremonies and celebrations really kind of end on the 15th. They kind of culminate with this one big celebration on the 15th of this year's on the 15th. They're on a lunar calendar. Yeah, so that is one of the most amazing things that kind of blew me away about the authors. They weren't really doing the research. They didn't really understand how China works. So over this 2-week period, of course, not everyone is not working and not everyone is either traveling or drunk, but a lot of people are going to be either traveling or drunk. That's going to be one of those things going on. So expect deliveries to actually absolutely suck in February. At the beginning of March, when they report those numbers, there's going to be a panic. The price will drop again, and you can buy those shares at a severe discount. And then in April, May, June, we're going to see a pretty large recovery in both XPeng and NIO. NIO's got a lot of projects that are coming to fruition this year, and I think that this is going to be a much better year for NIO this year than last year was, and I think that XPeng is going to have a stellar year as well. I expect XPeng to pretty much pass up NIO permanently, though. They are just really far ahead of them in a number of technologies, really far ahead of them in terms of their manufacturing process, a little bit behind NIO in terms of branding, but in the way they've constructed their brand, it's a lot more inclusive than NIO's brand is. Okay. Chris Palmer, $5 super chat. Thank you so much. I really appreciate this when I do this, guys. I never thought I'd enjoy being like a dancing monkey performing for peanuts, but I kind of do. It's actually kind of fun. Epic Hamster says, you didn't like AMD's beat? Actually, I haven't read about AMD's beat yet. I was actually doing some real work today. I don't like doing real work, but I had to. But yeah, I do actually sometimes do a job, guys. It is a fact. Occasionally I do work. But I had a client that I needed to do some business with today. And I had a few conversations that I needed to have about my other businesses. Luckily, I also wanted to announce that my bar is finally opening back up. We shut down for COVID. We are opening back up on March 12th. That is our day. And I'm extremely happy about that. Looks like we're getting personnel in place. Things are organized. We've done a little bit of a remodel. I've got other things that are kind of cooking too. They're going to help that. And the way the business segmentation was explained to me by my business partner, I really didn't understand how much money we're probably going to make in the future with this company. And I'm very excited about the future of that company as well, because it includes a few other moving pieces in there, including a new kitchen piece that's going in. So very happy about this year. I know that this year is going to be challenging for a lot of people, just as 2020 was challenging for a lot of people. Maybe 2021 was challenging for people. 22 is going to be my year, folks. This is going to be my year. And you know what? I hope it's your year too. All right. See, the Global X Uranium ETF is something you may recommend getting into. All right. So, Chris, because I'm actually a licensed certified financial planner, using the word recommend on a channel is something that I actually can't do. I will say one thing. I have looked into that uranium ETF myself, and I am enormously interested in that uranium ETF. I own one other ETF from that company, and it's the LIT. It's the Battery Supply Chain ETF. I really like that Battery Supply Chain ETF, and the symbol is LIT. I think this is one of the better ways to invest, especially if you're not all that comfortable with taking just tons and tons of risk. Spreading out your investment across the lithium battery supply chain, I think, is a very, very good way to capitalize on electric vehicles, no matter who wins. Because you're looking at lithium suppliers, nickel suppliers, manganese suppliers, you're looking at chemical suppliers. I think one of the biggest holdings in there is Albemarle, which they provide most of the precursor chemicals you need to build a lithium ion battery. And I think that LIT Global X ETF is something that everyone should really take a close look at. I know that it's been a lot of fun over the last 2 years picking stocks and making like exponential returns. I will say one thing, and many people listening to this aren't going to believe me right now. Everyone's a genius in a bull market, and it's been almost impossible to lose money on your overall portfolio over the last 3 years, since 2 years really. So since March of 2020 to now, it's been impossible to lose money, right? If you did it, you were just supremely unlucky, or let's just say supremely unlucky. But I think that you should be a bit more cautious in the future. I talked to a lot of people who are down 40 and 50% in their portfolios. If you are properly diversified, you really should not be down 40. Even if you're super aggressive like I am, you shouldn't be down 40 and 50%. You should be down more like 20%, right? So I would definitely take a look at being a bit more diversified. Right now is a really good time to pick up some quality companies. Right now, and depending on how long your time horizon is and how much risk tolerance you have, I think the technology is on sale, absolutely on sale right now. And like I said, we are looking at going through this transformational period of what Cathie Wood calls creative destruction. And we can talk about also, I know a lot of people are on the bandwagon, like I hate Cathie Wood bandwagon right now. I am not on one of those because I'm a long-term investor. And one bad year out of the last 7, especially when everything in technology is down, that doesn't convince me that her thesis is incorrect at all. In fact, it takes a lot more than one bad year to convince me that an investment thesis based on all the research that they've done would be incorrect. And if you're down on Cathie Wood at this point, I would bet that you haven't actually read all of the research and white papers that her team has put out. It's not just her. She's the leader of a great team, a fantastic team of folks that are out there who've done tons of research on what they see as the biggest the biggest gain in the biggest expansion of wealth in history, something akin to the Industrial Revolution, meaning it may be the largest expansion of wealth since the Industrial Revolution. And I tend to agree with them on that. So Russia could probably fill chip suppliers or cut off energy supply to Europe. So they can cut off energy supply to Europe, and that's certainly going to cause some temporary discomfort from Europe. But Europe can buy liquid natural gas from us. The problem is delivering it. So we've already finished one really large liquid natural gas port, I think in Poland, or in Germany rather, and we're looking at doing another one in Poland. The other thing is, if Ukraine and Russia were to actually go to war, don't you think Ukraine would send sappers to blow up the Nord Stream 1 and 2 pipelines? That's kind of the first thing that I would do in their case, is cut Russia off from their largest source of income. So I think that in the event that Russia goes to war with Ukraine, supply is going to be cut off anyway. And I think that they know that. I think that this is really just Russia saying, look, I'm big, I'm important, pay attention to me. But we are not going to allow, NATO is not going to allow Russia to determine who enters NATO and who gets to get into NATO. They're not going to do that. So I don't know what's going to happen in the future, but we're probably not looking at open tank warfare or something like that. So Nathan W says, how much do you charge for your clients? Nathan, what we do is comprehensive financial planning. It's usually based on the assets that you have. I'm not cheap. One of the reasons I do this channel is, of course, is to attract business, but I'm not cheap. We generally charge between $3,000 and $5,000 to do an entire comprehensive plan. And I'd be happy to talk with you offline about this. You can contact me through my email address. It's usually at the end of most of my videos, if I remember to put that on the screen. So you can email me there, and then I'll actually send you to the company that I work with. So what do you think about the 2 biggest online car retailers, Carvana and Vroom? It's like having a dealership with 3,000 cars to choose from their lot. So here's what I think about this. I think that these companies have a future no matter what happens, but Tesla is actually aiding their business model significantly. And let's talk about that for a minute. The dealership model, the current dealership model that we have right now, is hugely dependent on maintenance. And that's where they make tons and tons and tons of their money is maintenance. With Tesla vehicles, with electric vehicles in general, there's a lot less maintenance. It can either be fixed or it can't be fixed. And we're going to get to a point where the motors are actually kind of commoditized too. And we're going to see, like right now, Tesla's cost for their motor is, according to Sandy Monroe, is $784. That's what it costs them to build that motor. And if they have to replace that motor, they're charging 6, 7, 8 times that amount to do that, right? There's going to come a day, though, where we have third-party shops that will be able to replace that motor with a Tesla motor or even something different, and it's going to be cheaper and cheaper and cheaper to do that. And it's going to be commoditized at some point. The old days of needing an expert to fix anything are pretty much going to be gone. Parts for electric vehicles are going to be relatively plug and play. The need for skilled mechanics and skilled labor is probably going to decline. And the need that what is there to maintain? You don't need oil changes in electric vehicles. The brake systems are a lot more robust than the older ones are because the battery is so heavy. There are way fewer moving parts. There's like something like 75 or 80 moving parts in these electric motors versus 2,000 to 4,000 in an internal combustion engine. There's just a lot fewer things to break. You don't have transmission. The motors are right on the wheels, right? You can have anywhere from 1 to 4 motors all on the wheels. No need for a transmission. It's direct drive. So the dealership model, the way cars were sold in the past, is 100% completely under threat. I think that Carvana and Vroom actually have a pretty bright future. I think in the future, there may be many companies out there selling custom electric vehicles, or even the ICE vehicles that manage to hang on. They may end up ditching the dealership system they have now and doing most of their sales through something like a Carvana or Vroom. I really think that's going to happen in the future. Now, is it actually going to be Carvana and Vroom that benefit from this, or is it going to be someone else? That I couldn't tell you. I will say one thing though, like I didn't think the idea would work at first. I really didn't. And there's a lot of things that happened with the internet that I didn't think were great ideas when they first came out, and I was proven wrong. Carvana and Vroom are definitely a couple of those ideas. Although I should have known, people have been doing business with things like Auto Trader magazine for years, where you just see a picture in the magazine, and then you have to drive out and look at it. You can actually convey a lot more information using an app or using a website than you can through Auto News. Or I should have known this had better possibilities than I thought it did. So anyway, thank you for that question. Once again, guys, super chat features are on if you feel so inclined. I did got $5 from Chris Palmer earlier. Wanted to thank him again. Let me see here. What is next? Oops, we talked about that. And Bliudas A says, "Hey Jason, what about Kazatprom and Chemical Corporation, Ukrainian companies, first and largest?" So I don't really know enough about them to have an educated opinion. I got an email from someone the other day saying I should never say that on a live stream. I'm like, you know what? I'm going to say that all the time. If I don't know something about a company or anything at all, or enough to have an educated opinion, I'm going to say that. Uranium is one of those things that I'd probably rather hold. So there were a number of uranium company scams back in the early 2000s. And I think up to about 2005, 2006, like small cap uranium mining companies. And I got burned by a couple of those as a younger investor. And I do think that it's probably better to have those through an ETF. So I have a question here coming up, and I'm going to look at, hold on just here. So someone asked, what do I think about the Google split? And I think I made the comment earlier in the live stream that I love the idea of splits. It doesn't necessarily always result in this enormous run up in price or gain in equity in shareholder equity, meaning mathematically it doesn't increase your wealth at all. The price still has to rise. I think, though, that this is a precursor to getting them on one of the indices, probably the Dow Jones. So let me see here. CP says, are you going to catch the Facebook falling knife? The answer is no. So for a variety of reasons, I have never held Facebook as an individual stock. Now, that is not because I didn't, and I use Facebook all the time for business. I use Facebook all the time for advertising in particular. But for a variety of reasons, I never held them as an individual stock. I thought that a lot of their wealth had already been achieved before
they went public. I think that they waited a long time, or almost too long, to go public to a degree. A couple of other things too. The deal that they made with WhatsApp has not monetized in a way that that they anticipated, or a way that it was communicated to shareholders. Either that was one of the things I was disappointed about. But no, in terms of the Facebook falling knife, I think that it wasn't an accident that they announced the shift to the metaverse. We just saw their first quarter of declining usage. I'm one of those people that's a declining user. Like, I don't really use my personal Facebook anymore because I was really mean to people on it. Um, I'm I don't want to be a mean person, and I was mean to people on Facebook. So I decided to just kind of back off using it, not post anything for a few months. And then I figured out that other than using it for busy, I'm happier with Facebook not in my life. So that's my thing. And I think a lot of people, older folks who are the initial wave of users, folks who are my age, really, who are Generation X, we were the first users, really, and older millennials are the first users of Facebook. A lot of us are dropping off now, and younger generations are using other forms of social media and not Facebook. So, and we saw the same thing happen, albeit in a much quicker fashion with MySpace. MySpace was on fire, and then all of a sudden MySpace wasn't cool anymore, and everyone migrated to Facebook. Now folks are migrating to Instagram, folks are going to TikTok, folks are going to all kinds of other networks that are out there. So let me see here. Do you think the bull market of the past 2 years is over, with the government stimulus coming to the end and the end of Fed raising rates? The answer to that is no. I do think that we're going to have more volatility in the future. That is not over with by any means. We've had a nice breather for the last couple of days. Since Friday, we've had a nice breather. But if you saw further declines and further shocks in the market, I'm not going to be surprised. I think there's going to be a big shock after the first interest rate raise, and then after that, the rest of them are priced in. I think the market is mostly priced in a rise in federal funds rate up to 2% over the next 2 years, at about a rate of 0.25% per quarter. The bull market is not necessarily over. And I think that it's going to be a bit more muted, meaning that my prediction at the beginning of the year for folks in my Patreon group, I said that we're probably going to do like 6 or 7%. The S&P 500 will do 6 or 7% this year. I still think that that's probably going to be the truth. We are bouncing off the bottom right now, and I think we're going to go up a little bit and back down, up a little bit and back down. And I think that things won't be a little bit clearer until 2 or 3 quarters from now, when it's demonstrated that even if companies actually have to pay interest on the money that they borrow, that they can still make a profit. Okay. And that's one of the things, is there's just a shock that borrowers are going to have to pay interest at all on money that they borrow, because companies have not had to do that. In particular, they haven't had to do that for overnight debt, things like commercial paper, for almost a decade now. The commercial paper market has been 100% supported by the government. I remember back in the day trading commercial paper on an overnight basis with an APR of like 5%, and having had a huge book of rolling, huge book of business in the fixed income arena doing that, and generated a lot of fees and commissions for doing that. Those days have been gone for a decade, and I think that that's starting to come back to life just a little bit more. But no, do I think that the bull market of the past 2 years is over? No. And I don't even think necessarily that the bull market of the last 2 years wasn't anything other than an extension of the bull market that we've had since the bottom of the market in 2009, right? It took a long time for investor sentiment to actually catch up with profits. Profits were growing for U.S. companies since about the third quarter of 2009, and continued to grow all through up until we had the beginning of the pandemic in March and April of 2020. We saw a brief dip, but we never actually saw an official recession. And by official recession, I mean 3 quarters of declining GDP. That did not happen. So are we overdue for a recession? I would say that yes, we are overdue for a recession. Is there a reason to believe right now that I would need to see at least 1 quarter of declining GDP, 2 quarters of declining GDP before I'm like, okay, we're really close to being in recession here. And that's a trailing indicator, guys. We don't really know till after that happens. I think the biggest sign, though, like I said earlier in this live stream, is going to be that inverted yield curve. If you don't know about the yield curve, it's supposed to have this sort of regular upwards movement. where long-term interest rates are higher than short-term interest rates. When short-term interest rates end up being higher than long-term interest rates, when you have interest rates at 6 months and a year longer than interest rates at 10 to 30 years, then you're probably looking at a recession coming here pretty soon. Let me see here. Let's look at Tom Liu. Says, what do you think about Amazon earnings? All right, so let's take a look at actually, hold on. I pulled up the wrong thing, Tom. And so I haven't looked at Amazon earnings yet. Are those even out yet? Amazon earnings are tomorrow, it looks like. So I don't have a particular prediction on Amazon earnings. And so New York Post is saying that Amazon may include a prime price hike when it reveals Q4 earnings. That's interesting to know. So although the New York Post is not an entirely reliable news source. And when I say not an entirely, I'm being facetious here. They're not really reliable at all. But the New York was this published? This was published yesterday. Amazon did. I want to share right now. All right, so basically, this article says when Amazon reports on Tuesday how it fared on the holiday quarter, a key question is going to be. See, am I still broadcasting, guys? All right, somebody post something in the comments. Maybe frozen. All right, it looks like this. I will see you guys next time.